Covered calls are one of my absolute favorite strategies to talk about. I love talking about this strategy because it's a strategy that allows you to create a regular, ongoing, consistent source of income in your portfolio. It's an especially fun strategy if you happen to already own stock or come from a stock investing background. Before we can go too far along here, of course, I've got to go through a couple of important things. The first is that I am here as an educator. I'm going to look at a couple of real examples in this video, and the examples we look at, I need to be clear on, they are not meant to be recommendations. They are examples only. The second important thing I have to talk about is please be smart with the money you've got. Don't trade or invest with money that you can't afford to lose. Now, with those things being said, let's dive right in. Let's go over the agenda, everything we're going to cover in this video. We've got a lot to cover, so I want to jump right in. First of all, the concept. We're going to talk about what a covered call is. Now, you'll notice at the beginning of this video, the title was Traditional Covered Calls. There are different variations of covered calls. We could do alternative construction techniques. Each of these different variations of a covered call has its advantages and has its strengths. The covered calls that we're going to be talking about in this video are the traditional approach to the covered call trade. We're going to talk about how to build it. We're going to talk about the rewards and the risks involved with covered calls, and we're going to talk about how to manage it properly. That's the key in any investment, is management that is done correctly. So let's jump right into the concept behind covered calls. There's two keys to the covered call trade, or I should rephrase that, two objectives in the covered call trade. The first objective is that we're trying to take advantage of the growth potential of whatever company it is that we're investing in. When you buy stock, you are actually investing in a company. That's an important, critical thing to understand. When you buy a stock, you are investing in a company. We want to invest in companies that have growth potential. Personally, I would never consider buying stock on a company if I did not think that stock price was going to go up. So that's the first part of the covered call trade, the first objective. We're trying to take advantage of a stock that we think is going up in value. The second objective in the covered call trade is to create some short-term income using time decay. The neat thing about options is that old phrase, time is money. Well, in options, time is literally money. If you are buying an option, you're buying time. If you're selling an option, you are selling time. Time is money. And we're going to try and put that time decay on our side and make money off of time rather than spending money on time through the covered call strategy. Well, let's go into how to build this trade. The construction rules. First of all, we're long the stock. Long? Well, this is one of those terminology things that you need to get used to. A lot of learning about trading is learning terminology. The word long in trading means you own it. It doesn't actually have anything to do with time. Long has nothing to do with time when we're talking about options. It means you own the stock in this case. Or if I'm long a call, that means I bought a call. If I'm long a put, that means I bought the put. Long means you own it. So we're going to buy the stock. And we need to buy 100 shares of this stock at least. At least 100 shares. Now again, why would I buy a stock? Well, I would only buy a stock if I was bullish on that stock. So it's going to be a stock that I'm at least neutral on, but probably a little bit bullish. I don't want a stock that's going straight to the moon here. If I thought it was going straight to the moon, the covered call would not be the right approach, and hopefully this video will help you understand why. So this is a stock that we are neutral to moderately bullish on. Now once I own this stock, I'm going to put on the other half of this trade, that is selling a call. Remember, if long means you own it, short must mean you've sold it. So we are going to short a call. We're going to sell a call option, and we're going to sell an OTM. OTM stands for out of the money. We're going to sell a call that's out of the money, and it's going to be a call that's expiring somewhat close to where we are right now. Usually, the traditional approach would be within the next 30 days. So I'm going to sell a call that has about a month or less until it expires. Now, I want to do a little bit of diagramming here. We're going to do some coloring to help understand the concepts here behind the covered call trade. So let's pull up a whiteboard. We're going to say we've got a $50 stock. And we think this stock is going up, so we're going to buy 100 shares of that stock. That's our motivation. We think the stock's going up, so we're going to buy it. It's going to cost us $5,000. Why? Well, we're buying 100 shares of it. Now, the next thing I'm going to do is I'm going to sell a call option. I'm going to sell a call option with a strike price of $55. Now, when we sell a call option, we're taking upon ourselves an obligation. Remember, options are contracts. The job of a contract is to spell out rights and obligations. Well, if I sell an option, somebody's paying me money for it. In this case, let's say they're paying us $1. So we're getting $1 per share to sell this option contract. And a standard option contract represents 100 shares of stock. $1 times 100 shares means I'm pulling in $100 for selling this option. Well, by selling this option, I have taken upon myself some obligations. What are those obligations? I'm obligated to sell that stock for $55. Now, how much did we pay for that stock? We paid $50 for the stock. So if I buy the stock for $50 and then I turn around and sell it for $55, am I upset or am I happy? Hey, I'm happy. I paid $50, I sold it for $55, I made $5 per share on that stock. So if I end up having to sell the stock for $55, I'm not going to be upset. It's not a big deal because I'm making money. Well, let's go through the numbers so far. We've invested $50 per share in the stock. That's a total of $5,000 that we spent on the stock. So our investment, you could say, is $5,000. And then what we did is we offset that $5,000 by about $100. I shouldn't say about. We did get $100 from selling this call option. Now you could look at this and call it a passive return if you wanted. I don't know if that's the exact best term to use, but that's the term I'm going to use here. We're bringing in $100 this month on our $5,000 investment. Now that's a return of 2% this month. If the stock does not move at all at the end of the month, when this 55 strike call expires, it will still be out of the money. So if the stock just stays sideways, just stays at $50 all month long, this call is going to expire out of the money. And what happens to an option that expires out of the money? Well, it becomes worthless. It's just going to go away. So what's going to happen to that $1 per share that we received for selling it? We're going to keep it. Well, it's a good thing we sold it before it turned out to be worthless, isn't it? So we sold it for $1. Hey, it turned out to be worthless. I'm glad I sold it. I got to keep that dollar. That's a 2% return, or you could say 2% income that month off of my original $5,000 investment. Now, what do we want to happen in this trade? I just went through one scenario. Let's talk about ideal world. Ideal world. What we really, really want ideally is for the stock to go up a little bit. Not a lot. We want it to go up just a little bit. If it would go up to, well, technically, ideal world would be, man, I want this thing to go exactly to $54.99. Well, let's not be that precise. Let's just say we want the stock to go to $54. Now, if the stock goes to $54, at the end of 1 month, this call option is going to expire worthless. So I'm going to get to keep my dollar I sold for it. Plus, I made $4 per share on the stock. Now let's see what that kind of return is. If the stock goes up $4 this month, I get $400 because it's $4 per share. 4 times 100 is $400. Plus, I get to keep the $100 I sold the option for. Gives me a total profit in 1 month of $500. That'd be a 10% return in 1 month. Does that sound like a lot? Well, it's equivalent to 120% a year, so I'd say that's a lot. That's pretty darn good. I mean, if you could average 10% a month, you should be really, really happy. Now, of course, this is ideal world scenario that I'm talking about here. Well, we need to be prepared and be aware of, uh, shall we say, non-ideal scenarios. There's a couple of things that could happen in this trade. I'm gonna erase some of these numbers and start over here real quick. I've got too much scribbling on the screen. Come back to our $50 stock, our 55 strike call that we sold for $1. Well, we just talked about the ideal scenario. What we want is for the stock to go up just a little bit, go up to like $54, and we make money on the stock, which accomplishes our first objective in the trade. Remember the two objectives we talk about. First is growth, second is income. We also get that $1 of income. Well, the question I have now is, what's the worst case scenario here? What's the worst thing that could happen to you in this trade? Well, I'll tell you what the worst thing is. It's if the stock goes to zero. That's the absolute worst thing that could possibly happen to you in this trade. A lot of people will say, oh, but what if the stock goes up too fast? Aren't you going to have to sell it for 55? Well, yeah, that's the third scenario here. The third scenario is the stock goes up faster than we thought, and we end up having to sell it. That doesn't break my heart because I only paid $50 for the stock. I'm not upset about having to sell the stock for $55 if I only paid $50 for it. Plus, I still get to keep the dollar that I sold the call for. So the worst possible scenario here is if the stock goes to zero. Because if the stock goes to zero, I just lost $50 per share on my stock. That means I lost $5,000. Now, yeah, that's offset by the whopping $1 per share that I made on the call I sold. But having $100 in my pocket is not very comforting if I just lost $5,000 on my investment. So that's the worst possible scenario, is if the stock goes clear down to zero. Ideally, we want the stock to go up just a little bit, stay underneath the call we sold. The third scenario, of course, is if the stock goes up faster than we're expecting. If it goes up faster than we're expecting, hey, we're going to end up getting called out of the stock. But again, that's not that big of a deal. Now, I've just gone through three potential scenarios. I want to go through them in more detail. I want to go through the risks and the rewards of the covered call strategy and talk about some management techniques, and then we'll look at a live example. So let's talk about the risks first. I just went through the worst case scenario. You could lose your investment. The other risk is you could get called out of your stock. I mean, if the stock goes up too quickly, you have entered into a contract that requires you to sell your stock. Again, that's not the worst case scenario, but if you have an emotional attachment to your stock or whatever, you got to be aware that that is a potential risk there. You could end up getting called out of your stock at any time. Third risk is, on the short term, you have limited your profit potential. On the short term, you've said, hey, the most I could make on that stock is whatever I've sold that call for. So in the example we just went through, the most we possibly could have made on the stock was $5 per share on the short term. Let's go through the rewards. We've covered the scary part. Let's talk about the rewards. Well, first of all, we're going to keep the value of the call we sold. In the last example we just went through, we sold the call for $1. That means I get to keep $1 per share. In that example, it was $100. Well, the other reward is the stock growth. The growth of the stock. I get to keep whatever growth that stock has. Now, we also have actually unlimited long-term profit. So on the short term, our profit is limited by that call we're selling. But the reality is this is an unlimited profit strategy. It really is. So let's go through that again, and I'll explain why. We've got, again, a $50 stock. And on this stock, we sold a 55 strike call. We sold that call for $1. Now, what do we want the stock to do? Again, in an ideal world, what we want the stock to do would be go up to like 54 bucks. If that happens, our call option expires worthless. We make $1, and we made $4 per share on the stock. Well, what do? The next month we sell another call. I sell a call for $60 or a 60 strike call. Let's just say, I'm going to keep the math easy. Let's say we sold that one for $1. Now, what do we want the stock to do? Well, again, ideal world, what we want would be for the stock to go up to $59 per share. I'm making money on the stock. I'm also making money. I'm creating some short-term income by selling this call against the stock. So I sell that one, wash, rinse, repeat, keep going, keep going, keep going, keep going, as long as the trade keeps moving in our favor. That's why we say it has unlimited long-term profit. So on the short term, your profit is limited, but the reality is long term in this trade, you do have unlimited profit potential. All right, now let's talk about some management techniques. And these management techniques I'm going to talk about are by no means the only management techniques available to you. They're just the traditional management techniques. Now there's two parts to this trade. There's the stock we bought, and there's the call we sold. Even though they are connected, they are one single trade, we need to manage it as though it is two separate trades. So let's talk about how to manage the stock that we bought first. Well, the first thing we need to be aware of is how to get out if we're losing money. Now, most stock traders have some type of predetermined loss level that they're willing to take. You know, a common number I hear a lot would be 8 or 10%. You know, numbers around there. People say, well, if I buy stock, I'm going to give it 10% of wiggle room, and if I lose that much, I'm getting out. Or 8% or 12% or whatever your number is. Some people will look at a chart and use like a support or a resistance level to determine when they're going to get out. Trailing stops, things like that. They're all very, very effective at managing a stock. But the key is that you do have to have a predetermined loss level. You cannot wait until you're in the trade to determine your exit strategy. Once you do that, you're opening yourself up to allowing yourself to make emotional trading decisions. Emotional trading decisions are not normally the best trading decisions. You'll find yourself holding on to a stock longer than you should. I'll give you a little scenario here. Let's pretend you bought a stock for $50. And those of you who have already invested in stock before, this might sound familiar. You buy a stock, it's $50. Oh, look, a week later you come back and the stock's dropped to 48. No big deal. I mean, you're in this thing for the long haul and it's a good company. And, you know, you got to be aware that markets can fluctuate. So it's not a big deal. You're fine. Come back a couple weeks later and the stock that you bought for 50 is now down to $45. Stock's trading for $45. Again, hey, no big deal. It's a good company. You know, you went to lunch with the CEO last week and they told you everything was going to be fine. Come back a couple weeks later, now the stock's down to $35. And now you're getting really nervous. Oh my gosh, I invested $50 per share. It's down to $35 per share. Maybe I should get out. But I don't think I'm quite ready to take that loss yet. And man, I really do think this is a good company. I think I really, in fact, you know what? Maybe I'll buy more. Yeah. No, please don't. That's a bad idea most of the time. Doubling down on a losing position. Never say never, but most of the time that doesn't work out. Stock's down to 35 now. Okay. You know, I'm just going to give it another week. I'll give it another week or so. A week later, you come back, stock's really dropped. It's down to like $20. And at this point, you're like, shoot, I've lost this much. I might as well just stay in the trade. Now, does that story sound familiar? I hope not, but it's a very, very common story. We hear that a lot. Please don't allow yourself to fall into those emotional traps. There's all sorts of reasons we might hold on to losing trades. Please, before you get in any stock position, have a predetermined exit strategy. Whatever that is, whether you're using percentages or chart patterns or whatever it is, have it set. Now, the next potential exit strategy for the long stock is just hold until we get called out. Remember, we're selling a call on this option. That means we are opening ourselves up to getting that stock taken away from us at the strike price of the call we sold. That's called getting called out or getting assigned. The third potential exit strategy or management strategy, I should say, for long stock is hold until you've reached whatever your profit target is. You may look at a stock and say, yeah, I think this thing that I'm buying for 50 bucks has potential to get up to 60. Once it's around 60, I'm out. If you've got a profit target like that, that's another potential exit approach you could take to holding a long stock. Now let's talk about the option you sold. I'm going to give you a couple of traditional exit strategies here, and then I'll diagram it out. Hopefully it'll make sense. The first exit strategy is exit when 80% of the original extrinsic value of the option is gone. It's a lot of words, so I'm going to read it again. Exit when 80% of the original extrinsic value of the call is gone. I'm going to show you a diagram on exactly what I mean there in just a second, but first let's talk about the other exit strategy for the option that you sold, and that is just hold on until expiration. Just let it expire. If it expires worthless, great. Nothing to do. If it expires in the money, hey, you're going to get called out of the stock, which again, as we've talked about, is no big deal because you're making money on the stock. Well, let's diagram what I mean when I say 80% of the original extrinsic value of the option. So again, we bought a stock for $50 per share. In this case, we sold a call option with a strike price of $55. We sold it for $1. Now this option is out of the money, which means it has zero intrinsic value. There's no intrinsic value to that option at all. What that means is it's got $1 of extrinsic or time value. Extrinsic and time value are synonymous. Now let's say that the stock goes up faster than we expect. The stock goes up to $56. Now at this point, a lot of investors start to get nervous because you could get called out of this 55 strike call option at any time. Now again, that's not a big deal, but what if you do want to hold on to the stock for whatever reason? You've just said, yeah, I really want to hold on to this stock. I don't want to get called out. Well, a lot of people will panic at this point. They'll say, oh, I got to get out. But what happens if you panic? You get out of this call you sold, you buy it back, and then the very next day the stock comes right back down to 53. Well, you just panicked, lost a bunch of money on the call you sold for no reason. One of the things we need to recognize as investors, and it's going to sound obvious when I say it, but it's kind of funny how often we struggle with this. One of the things we have to recognize is that we do not know the future. I don't know what the stock's going to do tomorrow. This stock may keep going straight up, or it may turn around and crash, or it may do nothing. I don't know. I don't want to try and manage my position on something that I cannot actually control and something that I don't know. So this is where this rule, exit when 80% of original extrinsic value is gone, comes into play. All we can really trade on, all we can really invest on is what we currently know. Here's what we do know. We know that we bought a stock for $50, and now it's worth $56. We know we sold a call at 55 strike for $1. Well, my question is, what's the call option trading for right now? Well, let's say the call is trading for $1.50. Stock's gone way up. The call is now trading for $1.50. Well, that's not good because we sold the call originally for $1. Now to get out of it, we're going to have to buy it back. That's going to cost us $1.50. So we're losing money on that call option. But does that mean it's time for us to get out yet? That's the question. I'm going to use these three numbers to talk it through. We've got a 55 strike call. The stock is trading for $56. That call option is worth $1.50. Is that call in danger of getting exercised at this point? Well, put yourselves in the shoes of the person who bought the call. They bought it from you for $1. Now, right now, they could exercise that call and get a $1 discount on the stock. They could buy the stock for $55. That would give them a $1 discount on the stock. That means the intrinsic value of this option is $1. So they could exercise the call and make $1 on the stock. Or they could just sell that call to somebody else for $1.50 per share. Now, if that was you, which would you do? Would you exercise it and make $1, or would you sell it for $1.50? Or you'd probably sell it for $1.50. That's the one that makes mathematical sense. So at this point, this call is not really in any danger of getting exercised. Why? Because it still has lots of extrinsic value on it. Now, if this call, let's change a number here. Let's say the call was trading now for $1.02. Again, I'm going to use these three numbers here. Now tell me what's the extrinsic value of this call option. It's still got $1 of intrinsic value. That means it's got 2 cents left of extrinsic value. This thing is in danger of getting called out. We're close to, I guess you could call it par value on the option. $1 intrinsic value, the whole option's only worth $1.02. You're in danger now of getting called out. So if you want to hold on to the stock, that would be the time to buy back that 55 strike call. Remember the whole reason we sold that call option to begin with? The whole reason we sold that call option to begin with was to make money on time decay. That was our entire motivation on this trade. I wanted to make $1 on the value of time. If that option's trading for $1.50 and it's only got $1 of intrinsic value, well, guess what? I've still got 50 cents of time decay I can make on that option. That was my entire motivation for selling that option to begin with, was time decay. I've still got 50 cents in time decay. I'm still going to hold on to that thing. The reason I'm not panicking, again, is because I don't know the future. For all I know, the stock ran up too fast. It's going to come back tomorrow. It may go straight to the moon. I don't know. What I do know is I've still got 50 cents in time value I can make on that option, so I'm not going to panic and get out of it yet. That's why the rule is exit when 80% of the original extrinsic value is gone. Now let's look at a real world example of this. Let's pull up a chart here. Now I'm just going to go through this large cap watch list here, and I'm going to look for a stock that looks like it's on a moderately bullish trend. And the first one that's popping up in my mind, the first one I'm seeing, is this one right here, Procter & Gamble. So I'm going to pull up a bigger chart on that. But before I can get into this, I need to make sure there's no events coming up. Make sure there's no earnings announcements or anything like that. The next earnings announcement is 77 days from now, so I'm not too worried about that. I'm just going to do a little bit of analysis on the stock, and then we're going to try and do a covered call trade. Now, the first thing we need to do is look at the chart and say, which call should I sell? Now, the rule we gave you is out of the money. There's a couple of approaches to how you might select the call you're going to sell. A traditional approach would be just to look at the chart and say, hey, I don't think it's going to go above here, and therefore that's the call I'm going to sell. A secondary approach would be to maybe use a specific delta on the call you sold, maybe 25 deltas, 30 deltas, whatever delta it is you want to sell. I'm just going to go with the first approach I mentioned just to keep the example fairly simple. I'm going to say that we think that this stock, well, it's had a nice run. I think over the next month or so, this stock will probably stay under $83. I think it's going to stay under 83. So that's about that long. It's got to stay under that line. And if it does go above that line, I'm not going to be too upset about getting called out. So I'm going to say it'll stay under $83. So let's build the trade. To do that, I'm going to click on options right up here. And once the option chain loads up, in the top right next to the word backtest, there's this thing that says stock quantity. I'm going to type the number 100 in there. That's for 100 shares of stock. Then I'm going to hit enter on my keyboard, and you can see it populates the profit and loss graph on the right hand side. This is what the profit and loss graph looks like when you buy 100 shares of stock. That's the first part of the trade. Remember my motivation. I wanted a stock that I thought was going up. Now the second part of the trade was selling the call against it. Now the number that I chose was $83. And again, I just kept it simple. I looked at the chart and I said, I don't think it'll be above 83. So we're going to come over to the 83 strike call. and I'm going to hold my mouse over the bid price for that call. In this case, that's 63 cents per share, or $63. So I want to do a little bit of math here. I want to see what kind of return I'm giving myself by doing this covered call trade. Let's see. Let's pull up a calculator. Let's make it easy on ourselves here. So our original investment on this was $81.49. $81.49. That's $8,149. Now I'm offsetting that by selling this call option for $63. Well, let's see what that ends up being when we look at it as the term I used was passive income. 63 is our return on our original investment of 81.49, and that's about 0.75%. 0.75% in 1 month. Now, is that good? Well, good and bad is relative, but let's multiply that by 12 months a year. Hey, that's an extra 9% a year on a stock that you were going to own anyway. Now, those of you who already have a stock investing background, or even those of you who don't, how would you like to make an extra 9% on a stock you're going to own anyway? Doesn't sound too bad, does it? Now, again, the hope here is that the stock will go up. That's our hope, is that the stock will go up. Right now, the stock's at 81.5. What we'd love is if this stock went up, I don't know, $1 or so over the next month. If it went up like to 82.5, somewhere like that. Goes up to 82.5, I'm going to make $1 on the stock, which is $100. Plus, I'm going to get to keep my 63 cents that I'm selling the call for. Well, now the price is up to 65. So let's use the current value. 165 divided by our original investment of 81.49. Hey, that's 2% a month if the stock goes up. Now, what's the biggest danger here? What's the danger that's facing us? Worst possible scenario. Let me give you a headline. FBI raids company headquarters. Well, that's not good news, right? So FBI raids Procter & Gamble's headquarters. The stock drops to $50 a share. Turns out they're nothing but a giant scam. Stock goes down to 0 in a week. Well, obviously, that's the worst case scenario. You lose your entire $8,000 you've invested here. Now, we've got to protect ourselves against that. I know I'm using an extreme example, but hopefully it sticks with you. Stocks can go down. Have a preset exit point. Whatever your predetermined loss amount is, if in this case if it was 10%, you'd say, all right, if this stock drops $8, I'm out. If it was 8%, it'd be whatever that is. Or you may look at the chart and say, well, I think it's got a really good support line here, but if it drops below that, I don't want to hold the stock. You know, whatever your exit strategy is, make sure you've got it set before actually placing the trade. Now, of course, the third scenario is what if the stock goes up faster than I expected? Well, you're going to end up selling it for $83. Why? Well, that's the contract you agreed to. You said by selling that 83 strike call that you agreed to sell the stock for $83. That's what you've done. Now, you can see it's a very simple trade to set up. If I was going to actually put the trade through, come back to our options screen again. If I was actually going to put the option trade through, I just hit this big green button right here that says trade. Hit trade, come in here, hit review, and then I would hit submit. And that would submit the trade to the market. Hopefully we'd get a good fill on it, and we'd go through and manage it the way that we have discussed. Now this is the covered call. You can see why it's one of my favorite strategies. All you're doing is creating some extra income on a stock that you already own. And why not? You already own the stock. Why not create some income? It's almost like owning a house and renting it out. Hey, if you have an investment property, why wouldn't you rent it out? I get there's reasons, but hey, you might as well make some income on it while you're not living in it. Same thing with this stock. You might as well create a little bit of income on it. Just be aware of all of the risks and all of the rewards. So the next question, of course, is what do we do from here? I've got some action items for you guys. Number one, I want you to find a moderately bullish stock. Now, if you struggle with how to pick a stock or how to find a stock, call us. Allow us to help you with it. Number two, hey, practice selling some covered calls against it. So find a moderately bullish stock. Go out there and practice selling some covered calls against it. Do it on paper. The worst thing that can happen is you blow up a paper account and you have this magic reset button you can hit. Practice, practice, practice. Call us, allow us to help you while you're practicing. Take advantage of the help that you've got and have fun with it. The covered call is a fantastic foundational option strategy. It's one of my favorites to teach. Go out there, have some fun, and make some money.